Pakistan's economy is showing signs of activity. Mergers and acquisitions are picking up. Large-scale manufacturing is stabilizing and company registrations are hitting records high. But foreign investors are still cautious. So what's driving local deal making? Why isn't foreign capital following? Let's break down Javed Bukhari's Business and Finance Weekly article. According to the Competition Commission of Pakistan, there were 133 M&A transactions in fiscal year 2025, with 69 approved by the CCP. The total foreign direct investment or FDI from these deals was just $50 million. These included sectors like food, finance, aerospace, logistics, media, and e-commerce. At the same time, 64 domestic mergers and acquisitions deals went through in industries ranging from manufacturing to real estate. But foreign capital is still not following in at the scale Pakistan needs. According to the Overseas Investor Chambers, FDI remains below 1% of GDP, and several multinational companies have exited due partly to Pakistan's domestic challenges and partly to global strategic shifts. The key test is PIA's privatization, where there has been a surge in investor interest, mostly driven by support from the Special Investment Facilitation Council, popularly known as the SIFC. But analysts warn that unless this is backed by long-term policy and regulatory reform, it won't be sustainable. PIA, for reference, posted a net loss of 4.6 billion rupees, and some state-owned enterprises haven't even completed audits in years, prompting the government to push for transparency. Meanwhile, Pakistan steel mills may get a second life. Islamabad has signed a revival deal with Russia years after the plant stopped operating. Russia's deputy PM has called Pakistan a strategic economic partner, but how this revival plays out remains to be seen. On the domestic side, company formation is at a record high. The SCCP registered 35,000 plus new companies in financial year 2025, which was the highest ever in the fiscal year. Almost 100% of registrations were done online. The registry now has over 258,000 active companies. Growth was 27% higher than last year. January and May 2025 saw record incorporations, a positive sign for formal business activity. In manufacturing, the large-scale sector posted 2.29% growth in May, the third month in a row of positive numbers. Analysts attribute this partly to the cut in the key interest rate to 11%, but over the first 11 months of fiscal year 2025, LSM still recorded negative 1.21% growth overall. On the financial side, foreign inflows into T-bills totaled $1.28 billion, up from the previous year. But geopolitical tensions, especially after Indian aggression in May, shook investor confidence. In June alone, $24 million was invested in T-bills, but $113 million was withdrawn. Outflows from domestic bonds were 24% higher than inflows, and in the equity market, inflows were at $460 million and outflows were at $850 million. Without investment in people, education, skills, and opportunity, growth will be limited. And foreign investors are watching. For such explainers like this, subscribe to DawnNews English.